I'm not an economist. I'm only a property entrepreneur who likes to stay tuned with the market. And for that, I read a lot of books, I keep an eye on economic indicators, and I listen for signals. What I'm going to talk about next is a synthesis of my research from various news sites and online journals that I follow and read. And you are to make your own judgment. You got to be responsible for it. And even economists don't get it right all the time. And if they did, they would be the richest people in the world. So take whatever you can from it. If you don't like it, discard it. But I'll put in a lot of research together so that everything just becomes a little bit more clear than what it is in the moment. Let's look at year 2014. A solid and steady year for Australian residential market for major cities. Major market remained steady throughout 2014, and economists expect that interest rates will probably remain the same throughout 2015. And even ANZ has even predicted another fall in the interest rate. So the overall outlook for 2015 looks buoyant. What is the government doing? Government is placing a ban on borrowing to buy property within self-managed super funds. It has kept the investment loans to 10% of banks' capital lending requirements, and most banks are either at this limit, and most secondary lenders have already exceeded this limit, which basically squeezes the credit and destroys confidence and subdues demand. But not quite. According to me, it's a bad move. But let's look at what else is happening. Unemployment rate. Property prices are a leading determinant of household consumption expenditure, consumer confidence, employment, and growth. So when property prices rise, if my property was to go up in value, how would I feel? Well, I would feel a little bit wealthier, which would encourage me to spend more. I could get a bigger line of credit against my property, for example, which gives me more disposable income, so to speak, and which increases spending and employment growth. On the other hand, if the property prices fall, households feel poorer, which spurs pessimistic mentality, triggers savings and job losses. Let's look at unemployment rate. Unemployment rate has actually gone down for the month of January, and people are predicting that it's actually going to keep going up, but in January it's actually gone down, and that's a good thing. But whether or not it's sustainable, only time's going to tell. Interest rate and property prices. A steady increase in interest rate basically is an indicator that the property market is going to start declining. RBA has kept the interest rate low to boost the economy and stabilize the Australian dollar. And now I think because the Australian dollar has actually gone down to a record low, there might be an interest rate cut in the future. Low interest rate basically means cheap money, which basically means people can borrow more. And factors that matter to RBA are inflation, employment, economic growth, and mortgage debt of the country in relation to its GDP. And Australians owe about 1.8 trillion or $80,000 per person. This figure is amongst the highest in the developed world. Inflation rate. Generally, low inflation is equal to no growth in property value. Property's golden rule: not how to make the most, but how to lose the least. And when I think about this golden rule, the first thing that comes to my mind is our mining towns and all the people who actually went to mining towns to invest in them. And they didn't follow the golden rule, which was basically to lose the least. And if you compare mining towns and established cities, your established cities are a much better way to have properties for long term. As a thumb rule, holding property in low inflation environment is beneficial. Relationship between capital growth and inflation. Basically, the real growth is actually the difference between capital growth and inflation. So if inflation was 12% and capital growth was 15%, the real growth is the 3%. And if that would have happened, newspaper would be telling us that the market is booming. Let's look at inflation rate. Inflation rate's actually gone down, so which basically tells us that we should be holding property for long term. Population growth. Population is consistent. The cliche, populate or perish, is still relevant today. If the Australian population went into a long decline, the result would be catastrophic. So the governments continue to encourage the birth rate with tax incentives and social benefits, and immigration is on the rise. It is argued that immigration helps recovery. A lot of people argue that every immigrant that comes in the country helps create 3 new jobs. Let's look at population growth forecast. Population is actually set to rise, so we are on a steady increase as far as population is concerned. House price index. Well, house price index is basically, it's a measure of the price changes in residential housing. It's basically the difference in property prices. It's the fluctuation, the price changes. And RP data risk mark index does exactly the same thing. All it does, it measures broad property market movement. House price index at the moment has gone down as compared to last year to 1.5, and for the first quarter it's expected to go down. So let's look at some of the predictions for house price index. It's expected to decrease to 1.31 in the first quarter of 2015, which basically means that property will go down in the first quarter because everyone's coming out from the holidays. However, in 2016, HPI is to increase to 1.77, which basically tells us that it will actually go back up higher than what it is right now. In the long run, it is projected to trend around 2.55 by 2020, which is 5 years. In the next 5 years, if you look at where we are at the moment at 1.31, and if you look at the HPI's prediction by 2020, which is in the next 5 years, it tells us that there's going to be a huge capital gains happening in terms of property. The property prices will go up. And that's the forecast for quarter 1 in 2015. And see, by quarter 2 2015, which is basically starting April, the property prices are actually, if it's sitting at 1.31, they are predicted to go to 1.66, and then after starting July, they will go even further, and 2020 is 2.55 as we've discussed. Impact of Aussie dollar on property prices. Aussie dollar and property prices are 2 major indicators of how well an economy is doing. However, you can never look at the effect of the dollar in black and white terms on any industry. Every time the dollar goes up, some industries lose and some industries win. And it's the same when it goes down. So when the dollar is strong, that basically means cheaper imports, loss of local jobs in manufacturing and retail, because a lot of people now shop on eBay. A lot of people shop from overseas retailers. And everything is actually brought in. Everything under $1,000 doesn't attract any kind of GST or duty on it. So if the dollar's stronger, so it's actually more expensive for people to buy from overseas retailers. And if the dollar's weaker, expensive imports, which boost local economy and jobs, which basically means retail could do well. A lot of people would say, it probably cost me the same. It's actually better to go and buy it off from the local market. It discourages imports, so good local industries, especially retail. Boosts exports to trade partners like India and China. So anyone wants to import stuff off Australia, basically Australia exporting stuff to other countries, is actually cheaper for them because the dollar's now cheaper. It makes even cheaper for Chinese to buy more property in Australia. So if the dollar's gone down, let's look at it this way. If people wanted to come and study in Australia, it's now cheaper for them to do it. So basically more people will come in and study in Australia. And if people wanted to come and buy property in Australia, it's even cheaper to buy property in Australia because the dollar's gone down. So, and people who've been postponing their travel to come to Australia and visit Australia on a holiday, for example, it's actually going to be easier for them to take a holiday in Australia now. The falling dollar must always be looked at in conjunction with the cash rate, and in order to determine the real effect on the property prices. And if you look at the cash rate, It's actually been constant for a long time. It's been really low, and a lot of people say that it'll still remain the same, or because the dollar's gone so low, they might even cut it even further. So that's all speculation. If you look at the Aussie dollar forecast, it's supposed to go down, and it's predicted that it might go down. It's already touched 0.78 cents against the US dollar. Here's my point of view. I'd like to start with, where's the demand coming from? Is the demand coming from first-home buyers? I don't think so. If is the demand coming from internal Australia's demand? Not as much, but a lot from Chinese investors. So basically, a bulk of the property market is actually driven by Chinese money. And if you look at various news sites, they're all full of what's happening in China. So if you look at the influx of Chinese money, into the local residential property market, maybe the best thing that happened to the local economy. It also said the demand from foreign investors for Australian property is set to intensify for at least 3 years. Let's look at ABS and Foreign Investment Review Board. Chinese buyers account for 18% of the new property purchases in Sydney and 14% of the supply in Melbourne, excluding second-hand homes. That's a screenshot that I took from ABS. And if you look at temporary residents, foreign investors, and developers, this bar actually looks bigger than the one below. So, more interesting facts. Wealthy Chinese buyers have purchased 24 billion of Australian housing in the past 7 years. And over the next 7 years, an additional 44 billion will be spent on residential property. This is Credit Suisse estimates. Around 10 million of the wealthiest Chinese families, or 1 in 7 families, are interested in migrating to Australia. China is already the #1 source of foreign money in the local real estate market. CLSA is an independent research firm, and they spent about 6 months talking to the top developers in Australia like Lendlease, Stockland, Mirvac, and looking at their pipeline of what are they developing and what's supposed to come on the market at a later date. And they also did the same in China, and they came back with their conclusion was basically that Chinese investment in Aussie housing will continue for at least 3 years. And CLSA is even encouraging people to buy stock in Lendlease because they've seen what's coming and what Lendlease is actually going to do in future. Now, we got to ask ourselves this: is this the right time to get into property development? Well, for any development, it doesn't matter what's the state of the economy, but you got to do your research. You got to look at the market and invest in areas where new infrastructure is planned. You got to make sure that your numbers stack up properly, and a deal's a deal no matter where it is. If it stacks up, it stacks up. Practice caution when dealing with new property and investor-driven markets that are overly influenced by foreign buyers. Just make sure that you don't buy anything in a building where all the rest of the properties are actually bought by Chinese investors. Do your homework. Buyers, developers alike need to put in the time and effort to complete their thorough due diligence. You've got to do your due diligence no matter what. And in other words, finding the right deal and making sure that your due diligence is rock solid is paramount to